I'm going to spend a little bit of time talking about Brookfield Wealth Solutions and what we've been building. We set out 5 years ago to build, at the time, what we thought could be a scaled global wealth solutions provider. And I'd say where we are today, our conviction is only stronger. We think we can build a business that can compound capital for many decades to come, and in many ways is almost the perfect match to the things we do inside of Brookfield. Just to remind you, there's really two drivers in this business that give us a strong runway of growth going into the future. One is underpinned by what we've done for decades, investing into the global economy at Brookfield, where we invest in areas that just have tremendous scale potential. And two, it was touched on by Bruce, Nick, and others, this aging population phenomenon that's happening in the Western world, and our ability to offer income-oriented products. Just as a reminder, we've spent the last 25 years building out an investment franchise at Brookfield, focused in areas that have a multi-decade opportunity ahead of them and require trillions of dollars, and where we have a level of expertise that is unparalleled: real estate, infrastructure, data, renewable power, nuclear energy. And you've heard people talk today about all the capabilities we have. And often when we talk about those capabilities and the operational capabilities that underpin them, one of the great benefits of that is that it allows us to dial the risk down in those investments. And risk mitigation, cash flow projections, and duration are all things that are really important in an insurance balance sheet. At the same time, we are in the midst and in the very earliest stages of what I just touched on, a demographic shift that will take hold in the Western world, where people will live longer than they ever have, and there's a declining birth rate, and therefore the age of the population base of the Western world is getting older. I'm going to just give you some stats here. If you go back 100 years, it's not on this page, but if you go back 100 years in the United States, 1 in 20 people were over the age of 65. Very young population, industrious nation, growth. Today it's 1 in 6, and by 2050 it's 1 in 4. So 1 in 4 people will be over the age of 65. And if you think about what that means for individuals' needs for retirement income or income later in life, and what it means for Social Security and social welfare programs, it's going to put tremendous strain on fiscal balance sheets. That phenomenon is not just a US phenomenon, it's a Western world phenomenon. Europe, Japan, the UK, Canada, all Western markets are facing the exact same dynamic as family sizes have come down and as people start to live longer. And at the same time, if you go back the last 50 years, when almost everyone had a defined benefit pension plan if you were in the workforce, today it's almost no one. And so you have less protection, less guaranteed income, and you have a larger cohort of people who actually need the things that those plans were designed to provide. And if you sum it up from a math perspective, it means that in today's dollars, you have a $7 trillion retirement deficit. And with that backdrop and the combination of very low interest rates, we set out 5 years ago to build out a business that we thought could take the things we're really good at, long duration assets in industries that were growing, that generate cash flow, and if we do a good job, we could provide income streams to the exact demographic that's going to need it for many decades into the future. And when we started out, we thought, okay, we'll do it as a reinsurer. We'll back reserves from or liabilities from other insurance companies. We very quickly pivoted and realized the great opportunity in this space was to be able to have your own distribution, to be able to write your own policies, to have networks of advisors and agents and partners that could distribute your product throughout the United States. And it led us down a path of making a series of acquisitions. By 2022, we had what we thought was the beginnings of a nice little business, $45 billion of assets, very diversified across annuities, life, reinsurance, P&C, and pensions. But we were also in the midst of a once-in-a-generation inflationary backdrop. And the headlines here demonstrate, really since the early 80s, we had not seen that kind of inflation. The reason this is relevant is we've talked a lot today about what does investor-led or investment-led insurance really mean. It means that as an organization, we are not passengers or passive participants on the investment side. We're very active. And if you take the businesses that we acquired at that point in time, we took an investment mindset to them. We sold off virtually every long duration asset inside the balance sheets of the companies we acquired. We shortened the asset book down to 4 years. We stayed very liquid. We kept our liabilities long because they were written at low rates that were very attractive. We could not have predicted that rates would have gone up as fast as they did or even as high as they did. But odds were they were going to increase. And the government, and the Fed in particular, was telling us they were going to increase. They were saying we have to increase rates. They went up very quickly. We captured a tremendous amount of value. That's an investment-led approach to running an insurance business. And capturing all that value allowed us to build a capital base, gave us the confidence that we could then continue to grow and look for acquisitions. And you can see it in the results. We'll deliver $1.7 billion of earnings this year from 5 years ago, and a lot of that is the benefit that we picked up in those early periods. Along the way, by the end of last year, we'd made 3 sizable acquisitions. We'd done a number of small reinsurance deals. And maybe the most important thing, if you go through this, is we acquired every business for value, acquiring below book value in most cases. If you look at American National, which was our first business we acquired, highly diversified. American Equity, a monoline writer of insurance annuities, and Argo, a specialty writer. And Argo is an interesting one because most specialty writers, when run properly in the United States, trade at 2.5 to 3.5 times book value. This was a business that had some challenges, in particular on the investment side, and we were able to acquire it for 1 times book value, and we've taken the last few years rebuilding it into a specialty writer in the US with an investment-led approach. And we created business plans for all of these businesses. If you look at what we've been able to execute in these businesses, we sold all non-core lines of business at 1.6 times book. And what those non-core lines of business were not businesses that were bad insurance businesses. They just didn't fit the profile of what we wanted. We wanted low-risk liabilities that were highly predictable and that were stable. And there was many parts of the businesses we acquired, like healthcare, term life, universal whole life, products that were very insurance-driven or actuarially driven that just didn't fit our profile. They were more volatile. Even if they had embedded profits inside of them, they were unpredictable if you're an investment-led insurance company. So we sold off those businesses. And we started to work very hard on creating distribution. American National had never done more than $1.5 billion of annuity production in its 100-year history. And American Equity had never done more than $4 to $6 billion per year ever in its history. So those 2 businesses combined would do $5 billion a year in the maximum amount of annuity production ever. We'll do $25 billion this year out of those. And that takes a commitment to the operations where you're building up distribution, you're working with independent marketing organizations, RIAs, advisors, your own agent network, and selling your product through multiple channels throughout the United States. And more importantly, we're now working with the large-scale banks in the United States to get onto their platforms and further scale our distribution capabilities. We also immediately realized that we needed to plug into our real estate, infrastructure, power, and other groups across the Brookfield ecosystem. In the first year alone, we reviewed over $50 billion of investment opportunities that were inside of Brookfield, where we had an embedded information advantage, an operating advantage, and we started to put those investment opportunities into the balance sheet of our insurance businesses. That number this year will exceed 100 billion. We will have reviewed over 100 billion of investment opportunities that are suitable for the insurance business. We also maintain a significant amount of cash on hand. Again, high levels of liquidity, high levels of capital. Bruce touched on that sort of approach. In the insurance world, they call it a barbell approach, but really high levels of cash and liquidity combined with very suitable, high-yielding private asset investments. And lastly, we invested $30 billion out of our balance sheet into BAM products and BAM funds, helping all of the products and funds we have scale, helping us design new fund products, helping us create products that were more relevant to other insurers, and all of this will help further the growth of the overall Brookfield franchise for a long time to come. And what all of this led us down was a platform where we felt we had some foundational elements that were now built and could help us scale again in the future. Let's talk about that. So first, what does investment-led mean? Really, it's focus on where we have an embedded expertise, and that's all the things we do inside of Brookfield. But what we've not touched on is it also has an implication to leverage. If you're focused on investing where you have an information advantage and you have an advantage from an operating perspective and you can generate higher returns, you don't need to use leverage to generate your ROEs. And therefore, dial your leverage down. Most traditional insurance companies operate at mid-teens leverage. Some of them operate at 10 to 12. Some operate as high as 20. We run our business at 6 to 8 times, 7, 8 times leverage. And that number will decrease over time as we build up capital inside the business. So we don't need to use leverage to create returns. The returns come from the investment side. It also informs how we think of new products on the insurance side. Really, we're focused on low-risk, predictable liabilities. It's why we sold off many of the non-core lines that were in the business in the first place. And to put it in terms of just how we think about it from a returns perspective, you can see here what I was getting at in terms of the mix of privates versus liquids, the level of spread you can generate, and the leverage. And all of that drives to maybe at certain times even a comparable return to other insurance companies, but with much less leverage. We view that as being a much higher quality of earnings stream coming out of our business because lower leverage, same returns, more durable cash flows, more predictable liabilities. And this has allowed us to actually deliver what we've said we would deliver 5 years ago. All of our insurance businesses operate with an A ratings. 2 of our businesses got ratings upgrades over the last 3 years as we've been operating them and building up capital. We will generate over $2 billion of distributable earnings next year from 0 5 years ago. We have maintained a greater than 15% ROE since inception. This is an important point because what it means is every decision we make isn't just about growth. We're not just trying to grow AUM. We're making decisions to prioritize profitability over growth. And when you do that, there's times where you will scale back, and there's times we have scaled back. We could have pushed the envelope and actually distributed more or written more annuities, but we are very careful when we see rate movement in the market. We've been able to do this without taking any third-party capital in. This is important because our capital at Brookfield is permanent. It's long-term in nature, obviously, and therefore it's fully aligned with policyholders who sometimes own products that will be with us for the next 20 years. If we buy a pension out of the pension markets today, we could be paying somebody for the next 25 years. Having permanent capital backing them ensures full alignment, ensures we make decisions with policyholders in mind. And that is a really important long-term reputational matter for us as the business grows and scales. And then lastly, we have been very focused on making sure that we move beyond the US and grow in markets where this phenomenon of aging populations will offer further scale opportunities. So where do we go from here? The first 5 years have been very good. We have a great platform. but we now have the foundation in place to scale. Our in-house distribution, as I said, we now control the pen and the levers where this year we could do $25 billion of distribution. That number will only grow as we continue to build out those distribution relationships. We will maintain excess capital and liquidity, and the business today has $15 billion of cash and probably another $35 billion of short-term liquid securities that we could turn into cash overnight, and therefore allows us to weather any sort of macro movement or event and be really opportunistic to deploy capital. We often get asked, why did we both retain a P&C business and then grow a P&C business? And our answer is, A, it diversifies the risk profile, which is a good thing. You don't want to have a business with just one singular risk. B, it allows us to have a regulatory regime that is more favorable towards equity-oriented strategies, such that we can diversify the investment side of the house. We can do equities, we can do credit. It's also a low leverage business. And in specialty, where we operate Argo, it's not regulated, so you can write policies at anything that you think is economic. With the announcement of our transaction in the UK, we will now have a scaled platform in the UK in such that we can operate in Canada, the US, the UK, and we have the very early stages of a business in Japan that we're building out. And maybe most important is we have worked very hard with regulators to be transparent, to be leading, to make sure our disclosure is at the top end of their expectations, and to default to over-communication. This business is a regulated business, and you can either view that from a perspective of fear, or you can look at it as an amazing moat around your business. For us, it's an incredible moat. And the more we work with regulators, the more that moat widens and gives us protection and creates scarcity value for our business, and that's the approach we've taken. So we are taking a very active approach, making sure that rules are strong, transparency is strong, and that our regulators are our partners in this business going forward. And with all of this that we've built out, it now puts us in a perspective looking forward to be able to allocate capital to different jurisdictions and also to different lines of business. So as I talked earlier about the demographic shift of people aging, I just want to put it a little bit into the numbers around the US retirement system and assets sitting inside US retirement systems. So today, if you take, in 2025, you have over $40 trillion of assets sitting in US retirement accounts. That will grow to over $100 trillion by 2040. And if you look at 20 years ago, you had about 7% sitting in annuities. That's grown to about 10% today and should grow to 15%, maybe more. What's driving that? It's driven by, well, the retirement assets are growing because you have time value and you have more and more being contributed. But what's happening, and in particular with these changing rules in the US, is the combination of private alternative assets and annuities is going to allow individuals to earn an excellent return on the way up and then have a decumulation product on the way down. And what we will be able to offer at Brookfield is that combination through Brookfield Asset Management of alternatives that give people higher returns over a long period of time, and through our annuity business, a decumulation product that gives them income for life. In effect, what we are building is almost a defined benefit type system inside of retirement accounts, i.e. we can give people highly compelling returns, and we can give them, through our annuity and insurance franchise, a way to decumulate all of that for the totality of their lifetime. And this should present a very, very compelling opportunity for us to scale the business in the long term. If you take the other parts of the world, this is more meant to show the scale of the retirement assets in those as well. All of this to say, with our recently announced acquisition, we will now have a platform with $180 billion of insurance float. including the amount that the UK business distributes per year or participates in annually, will start next year with 35 billion of new gross inflows coming to the business. We have about 10 billion of outflows, which means we should be 20 to 25 billion of net inflows year over year starting next year. So the numbers start to get staggering. And all of this positions us for highly compelling returns, but obviously without compromising, or highly compelling growth, but without compromising our returns. I'm going to spend a little bit of time on value here, because the other thing that we've seen over the last 3 years is that many of the platforms in the US that have traded at pretty healthy valuations. So if you look at, and we're not going to call anybody out here, but 3 large-scale transactions in the US where you have life and annuity players that have sold, 2 alternative asset managers or private equity sponsors, have all traded in that 1.4 to 2.2 times book. And if you recall, we put up where we've been transacting. It implies the average book value multiple at about 1.8 times. If you take that and you take our group capital, which is how these multiples have been ascribed to our what we call capital and surplus group capital of 17 billion, and you deduct some holding company leverage we have, the business today, the capital in the business is worth $26 billion. So when Nick talked earlier about the fact that we've invested 12, it's worth 26, all that accretion has come through the system really to reflect the business we've built out. If you take it the other way, where you say, okay, it's 26 billion, what does that imply for a multiple? And you back solve the multiple based on the current earnings profile, it's about a 15 times multiple. So for all the people who are modeling out the business, this is meant to demonstrate this is where these platforms are trading today. This is not our view of value, this is where the market trades. And it really just reflects that demographic shift and this enormous opportunity that's in front of us, where everyone is looking at this saying there's a large cohort of Americans who will need retirement income, and these platforms are designed to deliver into that. And if we take that and we look forward 5 more years and we say, well, where can this all go? Again, from a pure assets that we could manage perspective, and you start at that 180, as I said, we should net out to about 20 to 25 billion a year net flows, which over 5 years could add 100 to 125 billion. And we've added some M&A here. Highly likely we will do a little bit of M&A along the way. It's not out of our track record. And so we feel pretty confident that we could get this business well in excess of 300 billion by the end of the decade. And again, if you run that through distributable earnings, it leads us to a path where the numbers become enormous, close over $5 billion of distributable earnings by the end of the decade. So this business has tremendous, tremendous growth potential and really the ability to participate in this very large-scale demographic shift that's occurring. From a value perspective, today the business is worth around $20 a share for Brookfield. We're using next year's earnings at $2.1 billion. And that 2.1 is net of the fees that accrue to BAM. That's the net earnings that get retained inside the business. And by 2030, the business could be worth somewhere between $42 and $52 a share. So I'm going to summarize some key points here. We have spent the last 5 years building out what we think is the next global part of Brookfield that should deliver growth for many decades to come. And the ingredients in the marketplace are set, and our job is to exploit those and really build out the business around them. The opportunity set is enormous. It's enormous on the investment side of the house, and it's enormous on how we source capital. And if we can bring that together, there is a long runway ahead. maybe the most important thing we've done in the last 5 years is build the foundation for scale. The building blocks of this business are now in place with distribution, with the discipline that we have, with the capital we have, our regulatory expertise. And all of it will work as long as we stay committed to this investor-led or investment-led approach, which really forces the discipline to put great investments that are completely suited for long-term liabilities, keep the liability risk low, keep the volatility low, and keep the leverage down. And if we could just do all that, we'll have an amazing business. Thank you.